Hey everyone, welcome back to the channel, your number one source for income-oriented investing. How to generate passive income from a diversified portfolio of high-yield funds. And in today's video, we're going to check out two lesser-known covered call ETFs from a lesser-known covered call ETF fund manager in Canada. The fund manager is called Mulvihill. If you haven't heard from them, that's because they used to be called Strathbridge. They recently renamed their firm Mulvihill. So they have actually launched this year, very recently, two covered call ETFs that use leverage. And one of them is in the financial space, covers the Canadian banks, the big six Canadian banks, and the other one has to do with healthcare stocks in the US. And I know what you're saying, Adrian, that's all we need, right? Another Canadian banks covered call ETF or another healthcare covered call ETF. We know that the Canadian market is stacked, especially with those two sectors. But these two are extremely interesting because they have a very unique covered call strategy where you will capture 100%, I repeat, 100% of the upside of the portfolio of the stocks within the covered call ETF. This is extremely different from all the other covered call ETFs out there, which you're always giving up some upside potential, right? So how did Mulvihill figure out a way to capture, to give you enhanced yield with a covered call strategy, but capture 100% upside? Let's check out these two ETFs together really quickly. And then I will speak to the president, the man himself, Mr. John Mulvihill, and we'll talk a little bit about his firm, these two ETFs, the covered call strategy, etc., etc. You don't want to miss it. If you're a covered call ETF fan, like I am, these are very, very unique, and you should definitely consider these for your portfolio, especially if you're very bullish on the underlying. So let's check it out together right now. All right, everyone. So Mulvihill currently has two enhanced or leveraged covered call ETFs. The first one is CBNK, which is the Mulvihill Canadian Bank Enhanced Yield ETF. Just like the name says, this is the big six Canadian banks with covered calls and 25% leverage. So it's just the banks. There's no life insurance companies or anything like that. So here's the highlights of the fund. What does this ETF do? It invests in the big six Canadian banks. 25% leverage is used to purchase additional shares for the purpose of writing options. By using leverage, the portfolio generates income from option premiums. That's covered calls, right? And here's the key of the covered call strategy. And this is what's very unique about Mulvihill's strategy here. While maintaining close to full exposure to the underlying portfolio of stocks, right? So the key to understanding this is they're only writing options, or they're only doing the covered calls on the leveraged 25% portion of the portfolio. So you literally have full upside participation. So you see that here in their fact sheet. If you open their fact sheet, they explain it in details here. If you just scroll down, how it works. Here it is right here. So your $100 investment, basically $100 of that you're investing in the big six Canadian banks, but then they use 25% leverage, or they borrow $25, and that's what they use to purchase the additional shares to do the options on. So you literally have 100% upside participation in rising markets. So this is completely different from all the other covered call ETFs that I've seen on the Canadian market, where you're always giving up a portion of the upside when the stocks go up, whether it's 33%, they're writing it on 50%, 25%, you're giving up upside participation if the stocks go up with those covered calls. But with this strategy, you're not, because they're only writing options on the leveraged 25% portion. So I found this very unique and fascinating. And I mean, hey, the yield is pretty good. It's about double what the Canadian banks give you, right? The Canadian banks altogether on average probably give you about 5%. So with that leverage, you get extra yield, and then you get extra yield again with the option strategy. So 10% yield on the big six Canadian banks, and you don't have to give up any upside. A very, very unique ETF. You might be wondering, well, what's Mulvihill's experience with the Canadian banks? Well, listen, they just rebranded recently to Mulvihill. They used to be called Strathbridge. And in case you didn't know, they basically created the very first Canadian six banks split share fund back in 1996. I actually used to own this fund as well. It's PIC.A. That is the stock symbol for the Class A shares. And right now, by the way, it has an incredible yield of just under 20%. But this video we're going to focus on the ETFs, but I just want to mention it to you because Mulvihill does have a long track record and a lot of experience with covered calls, with writing options, and with the big 6 Canadian banks. So very, very fascinating. If you're really bullish on the 6 banks, for example, you want to invest in the 6 banks, you don't want to give up any upside, but you want enhanced yield, you're an income investor like me, CBNK could be a great option. Management fee is 65 basis points, by the way, 0.65. The MER is going to be much higher, of course, because that includes the leverage cost. Remember, yes, it's 2.21, but guys, it includes the leverage cost. Leverage is not free. Borrowing costs are not free. Second ETF that uses the exact same cover call strategy, 25% leverage, options only on the leverage portion, so you have 100% upside, is XLVE, the Mulvihill US Healthcare Enhanced Yield ETF. Another sector that's very popular on the Canadian market because it's very underrepresented in the Canadian market, but I'm talking about the covered call market. There's a lot of them, right? Harvest has one, Brompton has one, BMO has one, Evolve has one. There are a lot of covered call healthcare ETFs, but again, this is a very unique one where you capture 100% upside if the stocks go up, and you have a nice yield of a little over 8% here as well. So same exact strategy, CBNK. And another interesting thing about this one is it's not like 20 stocks or 15 or 20 stocks. You have a lot of stocks here. So it looks to me like there's a good 30 to 40 stocks at least. So you do have a lot more diversification in the healthcare sector compared to other healthcare covered call ETFs. That could be a good thing or a bad thing, though. Just it's the way you see it. It's your personal preference. But personally, I always like more diversification. And of course, if you have a little bit more of the smaller names, it's easier to generate those premiums as well. So it's a big mix of not only pharmaceuticals here, but also medical supply companies, insurance companies, et cetera, et cetera. Everything to do with the healthcare sector. So very, very unique, everyone. If you're an income investor, you're a fan of covered calls, but you're very bullish, you firmly believe in the sector, you don't want to give up upside, but you want enhanced yield, XLVE for healthcare and CBNK could be a really great option. So now let's talk to the man himself. We chat for over 30 minutes with Mr. John P. Mulvihill. We'll talk all about his firm, these covered call ETFs, why they decided to do this very unique covered call strategy, etc. So let's take a listen. All right, everyone, I'm happy to announce and introduce to the channel John Mulvihill, president of Mulvihill ETF. So John, it's the first time on the channel. Welcome. Very excited to talk to you and discuss some of your covered call ETFs, which my channel is all about. How are you doing?
Great. Yeah, thanks for having us. And we've had the opportunity to watch your channel over the last little bit and see some of our competitors on there, and learn about what other people are doing in the space. And as you'll hear from us, we have a long history in the option space and managing these types of mandates. And I think we have a bit of a different flair that you'll see here that we put on it. So it'll be great to have the conversation, and hopefully your audience and your clientele get something out of it. So.
I can't wait to talk about it. So John, let's start real quick. Give me a background on yourself, on Mulvihill. So correct me if I'm wrong, you used to be called Strathbridge. So maybe just give me a quick summary of yourself, your history, and the history of the firm, if you don't mind, for the audience.
Sure, yeah. So we actually date back to the old Canada Trust days. So we were part of Canada Trust in the early 90s, 1995. We purchased the investment counseling arm out of Canada Trust. We rebranded it Mulvihill Capital Management, and in 1995 began issuing closed-end funds with option-based strategies to retail investors and their advisors across Canada, really becoming one of the first in the space within Canada to do those types of strategies. As the business evolved and ETFs came along, the closed-end fund business, obviously, there were a lot of sort of structural flaws that became apparent, like trading at discounts, and the opening NAV opening up after expenses down around $9.50 after you issued at $10. So, the closed-end fund business really went through a bit of a reorganization. We rebranded into Strathbridge Asset Management back in 2010, and with that move, we also spun out our fixed income, and a large portion of our high net worth business to a group of employees at the firm. And really what that allowed us to do was entirely focus on these equity-based option strategies at that time. last year, at the beginning of last year, I took over as president of the firm. We rebranded back to Mulvihill with the launch of our first ETFs in February of 2022, which we're going to talk about today. So, I think really the 10,000 foot view of our firm is a ton of history in terms of managing these option-based strategies. We've learned a lot of lessons, which you're going to hear about today. The team we have here is really quite unique. I joined out of a large Canadian pension plan in the alternative investments group back in 2008. So I've been with the firm for about 15 years, and I'm bringing down the average tenure of the portfolio manager. So there's 6 portfolio managers today. The average tenure they've been with the firm is 23 years. So a ton of experience working together over multiple market cycles, managing option-based strategies for clients, whether that's closed-end fund, open-ended funds, institutional, or high net worth. Today, we have those 4 business lines, and then more recently, the ETF business. So a lot of history and a lot of experience that we hope to convey today.
Yeah, we'll definitely touch up on that as well. So thanks so much for the summary. Very, very appreciated. Let's start off by talking about which seems to be one of your core competencies, the Canadian 6 banks. And you guys recently launched a fairly new ETF, CBNK, the Mulvihill Canadian Bank Enhanced Yield ETF. This is, of course, listed on the Canadian market, right? The Canadian exchange. It has over 10% yield. It's basically the 6 banks, and also uses 25% leverage and options. So tell me a little bit about this ETF and what I think is, one of Mulvihill's core competency, the 6 banks. So tell me about this ETF. Why did you guys decide to launch it? What's it all about?
Yeah, so I'll even back up before the ETF into our Premium Income Corp that also trades on the TSX. It's a split share on the big 6 Canadian banks, and it was actually the first covered call writing bank fund in Canada. So we launched this product back in October of 1996. So it has over 25 years of history. It just owns the big 6 banks. It does the option writing strategies, and through the split share structure, the Class A obviously has a very nice yield, and the pref much more stable. But you're talking launching in 1996. You're over 25 years of history managing a Canadian bank option-related strategy. And you learn a lot of lessons. That fund has actually never missed a distribution payment in over a quarter century. It's very attractive right now. The preferred share trades at a pretty substantial discount to the NAV. So it's about a 15% yield to maturity on the pref right now in the market. But as I mentioned, really, when you manage something for 25 years, and you're sort of hyper focused, particularly in the option world, you learn a lot of lessons in terms of what works and what doesn't. And it's really what led us into launching the Enhanced Yield Canadian Bank ETF. And it's going to sound kind of odd, but one of the lessons we've learned from writing options on Canadian banks is that it's actually a terrible place to go and write options for a couple of reasons. And so, when you look at Canadian bank stocks, a couple of things that really impact the premium you receive from writing options is high dividend yields and low volatility, which the Canadian banks have both of. And so when you start stepping back and you're saying, all right, I'm getting low volatility and high dividend yield, which is reducing the premium I'm receiving from writing options. And then you put as well that the Canadian banks historically have more or less gone up over history at a pretty rapid pace. You end up with this environment in which you're collecting very little premium to compensate you for potentially what you're selling away on the upside. And so as we began to think about this more and more, we came up with this concept on the Canadian bank, on the ETF side, where we can bring together this idea of utilizing leverage and the option writing strategy in order to really be the provider in this space of both growth and income. And so what you'll hear from me later on in the conversation is we have a lot of thoughts around sort of the lower volatility idea of call writing and minimizing risk, which we're not as into as much. We really use these for generating yield. And with this Canadian bank product, we really wanted to provide this idea of growth and income in this space. I'm going to throw up a quick chart here, if you don't mind,
Not
just
at
to
all.
sort of get, I'm a visual learner, so I like to show images. You can see that, okay?
Yeah.
So, really the essence of what we're trying to achieve with CBank in terms of the underlying exposure in the options, if you give us $100, we take that $100 and we invest it equally weighted in the Canadian bank stocks, completely unencumbered from option strategies. So one way to think about that is that sort of your beta of 1 or your passive exposure to the underlying group. We then go and we employ this leverage. So we take that $100, we go to our prime broker at National Bank, we borrow an additional $25, and that $25 sleeve is used solely for the purpose of option-based strategies. So with that
Okay.
$25, we go out, we purchase additional shares, and we write calls on them, or we pledge that share, we pledge that cash as collateral, and we go and write put options, which again, I think we're going to touch on here in a minute. So really, at the end of the day, what you have here is an underlying, completely unencumbered passive exposure to the underlying group. And then this $25 sleeve that's working to generate the income for you in the underlying portfolio. I'm just going to switch to this next slide here. This is the last 12 months that we've been able to generate, the last 12 months of premium we've received in the Canadian Bank Fund. So what you're looking at here, the top row, is the dividend income we've received over the last 12 months. So 5.7% has come into the fund from dividend income. And you can see that just from the option premium, we've been able to generate on the leverage part, we've been able to generate an additional 5.3%. So we're able to fund this distribution through the dividend income and the option premium, but we're doing it without having to be really sort of 50% written on the portfolio and giving up a lot of drag should these banks turn. So really what that allows us to do is become a very high yield provider or very high yield exposure to this group while also providing upside to the group. This is just the big six yields. I believe this is the end of August. So obviously the banks have come off quite a bit. The yields have gone up. The average of the big six at the end of August was 5.3%. We're yielding 10.3%. So about 2 times the underlying dividend yield of the Canadian banks is what we're aiming to achieve with this Canadian bank product. So, it gives you a little bit of flavor of sort of our experience and what we're trying to accomplish. So it's really that passive underlying exposure, and then very much on the option side being very active in terms of generating that option premium.
Okay, a lot to unpack here. By the way, I appreciate you sharing the slide. So you definitely have my attention because this is extremely unique. So I want to unpack 2 things that you talked about. First of all, you talked about the premium income, right? That's for in case the audience members don't know, the stock symbol is PIC.A. It's a split share fund. It is still listed. It's still going strong. And it's actually probably the original 6 banks split share fund. Not many people know that. And I'm just going to share my screen real quick. This is exactly what you were talking about when you're talking about Premium Income Corporation. Here it is. So of course you have the preferred shares, you have the Class A shares. And like you said, this has been around for a really long time, 1996. And one thing I will point out, and because I own PIC.A myself in the past, I know that this is one of the more unique split share funds because it doesn't have that rule that if the unit NAV is under 15, there's going to be no payout. So PIC.A always got a payout. It is a quarterly payout. Correct me if I'm wrong there, right? It's a quarterly distribution. And I remember in 2020, it's the only split fund that kept on paying. Although they did reduce the distribution, they never stopped paying it. So this is, like you said, this is what you were talking about. And another thing you were alluding to is that you found that after 25 years, writing covered calls on the 6 banks is maybe not a good idea. I understand that completely now because I understand what covered calls do. If you're writing covered calls on something that's always doing well and gradually going up over time, you're going to lose a lot of that upside. So that's the first thing I just want to share with the audience regarding PIC.A, regarding the Premium Income Corp. Second thing is very unique covered call strategy here. This is extremely unique, unlike the other providers that you have on the market. Correct me if I'm wrong here, with your CBNK ETF, you have 100% upside with the banks. You're not giving up any upside because you're only writing the covered calls or the puts or the options on that leveraged 25% portion. Do I have that correct? This is very unique.
Right. So and what we've actually seen is because you also have the leverage embedded in there. So it's not only just 1-to-1, but it ends up being a little bit more than 1-to-1. So what we've seen since we've launched it is it ends up being kind of almost 1.15-to-1 on the upside, right? Because you're still getting some upside from the.
That's true. I didn't think of that.
Stuff, right? Yes. So it's not sort of just the option stuff drags and that's it. There's still some value there, but you have fully exposed, and then there's also the leverage piece that adds not quite 1.25, but it adds a little bit. What we found is about 1.15 is where we're kind of around now. So
then by saying that, you're basically saying you're probably writing out of the money calls, right?
Writing, yeah. So I guess it'll probably lead us into our next conversation around
Yeah.
active,
Talk to
the
me about
active.
the cover call strategy.
Yeah. So, the it's you almost need to unpack that question more. So you're asking about covered call writing. We're not just a covered call writing firm. So, another thing that we've really found over time is that it adds a lot of value to have the flexibility to write calls and also write put options. And so, really what we aim to do is we're looking for the correct volatility in the correct environment to write calls and write put options. And so often what happens when investors are looking or managers are looking at options, they're looking for higher volatility areas to go and write options because that's where you get premium. Part of the problem we found with that is that volatility and the underlying price are usually inversely related. So as the price goes down of a stock, the volatility is typically higher. And
Yeah.
so what often ends up happening is that you're writing a call option after the stock has already gone down in order to get that higher volatility, but you're often selling away your upside because the stock rebounds and then goes higher if you follow.
Yeah.
So one of the things we've learned over time is that a great way to be able to capture both the higher volatility and not selling away as much of your upside is utilizing written put options. So we go out after sort of the stock is oversold, the volatility is high. Rather than write a call, we write a put option. We generate typically more volatility because there's a bit of a skew that also exists in the underlying. So you typically get more volatility to write a put versus writing a call. And so we get more put option premium in the fund. And then as the stock goes higher, we actually capture more of that upside because we have the potential to roll those put options as the stock moves. So one of the methods that we have to try not to drag in up markets is utilize written put options versus written call options. That's sort of one aspect of the option-based strategy in terms of how we add value. A couple other areas in terms of the activeness that we employ. We have the ability to purchase put options in this fund. So, I think one of the misconceptions, if you will, of option writing based strategies is that they lower the risk in the portfolio. So, my personal view is that they lower volatility. They don't necessarily lower risk. So there's a big difference between lower volatility and lower risk. What I mean by that is that when you're looking at volatility, the way you calculate volatility is both up and down around the average. So you can lower the volatility by just not participating on the upside, right? So that will come across as a lower volatility fund because you've dragged on the upside. What we want to do is be able to lower risk. The way we do that is through purchasing put options. So we can actually go out and we can hedge the underlying exposure through an index or through the ETF in order to preserve the capital on the downside. One last thing I would say on this idea around options being sort of a lower risk strategy or option writing being a lower risk strategy, if you actually look at option-based funds relative to the broader market, we can use banks as an example. When the Canadian banks are going down 20%, a lot of the option-based strategies are still going down 17, 18, 19, 20%. So, you do get a little bit of relative outperformance, but you're still down fairly significant. And so that's what we wanted the ability to do, is have these put options that we can purchase in order to, try and guard against severe drawdowns very selectively. So that's not always in the portfolio, but when the right opportunity arises, we do have that flexibility.
Very, very interesting, very unique.
Yeah.
By the way, I completely agree with you. I like to always say less volatility instead of less risk, because the risk is you're still holding the six banks. The risk is always the underlying, right? So you definitely have less volatility with option strategy. So listen, John, I'm very fascinated by this because this is honestly very, very unique in the market. Typically, you have, a portfolio of stocks and they'll write, covered call. The moneyness could be different, but it's typically 50% of the portfolio, 33. But with your funds, your ETFs here, not only are you getting an enhanced yield, but you're pretty much you're not giving up any upside because you're only writing options on the leveraged portion of the portfolio. And because maybe there's some put options and some out of the money calls, you're actually capturing more than 100%. So I get it. I hope my audience gets it. I find this very unique. I think this is a great ETF for people who are very optimistic. They're not pessimistic about the six banks. They think they're going to go up and grow. They want to capture everything. So instead of but they want enhanced yield. So this is, I think, a great ETF for that type of investor. So thanks so much for explaining your cover call strategy. Very, very unique. I love, putting the put options in there. I think that's That's exactly what I want to hear, honestly, every time from my covered call fund manager. First of all, I want a unique approach, and I want a dynamic, active approach. Those are the ones I prefer
Yeah.
over a more systematic and set in stone approach. So thanks a lot, John. Much appreciated. Let's talk about the second ETF. This is a little bit newer. This is the healthcare one. So it's XLVE, the Mulvihill US Healthcare Enhanced Yield ETF. You have right there on your website over four times the yield of US healthcare stocks. And this is really a sector that's underrepresented in Canada. And there's a lot of competition, let's be honest, with a healthcare covered call ETF. So are you doing the same type of strategy here? I'm assuming yes, where you're capturing all the upside. You're only writing options on the leverage portion, the 25%.
Yeah, exactly. So, really the idea behind this one, and you're absolutely right. There's a lot of competition in the Canadian ETF space to provide exposure to healthcare outside of Canada. So the healthcare sector in Canada is essentially meaningless. I think it's four stocks today in the market and represents under 0.5% of the index. So Canadian investors are typically very underrepresented in the healthcare sector as a whole, and so it's been a real opportunity for other providers to get into this space and attract assets, and so that's obviously made it very competitive. So why would we enter a space where there's already 8 or 10 healthcare ETFs from seemingly every provider? So we have a bit of a checklist that we go through when we want to launch a fund. So
Yeah.
first and foremost, we want to be in something that we'll put our own money behind. So we want to be excited about the product to the point where our own assets are going into the fund. So I personally invest in all three of our ETFs and our closed-end funds as well. So that's first and foremost. So when I look at the healthcare sector, it's really an area that I think could very potentially be the next leadership for the market whenever the next bull market starts. So very rarely over history does the previous sector leader maintain its leadership after a bear market. So we had a nice bear market last year. I think it's very unlikely that the technology sector, given valuations and given sort of the growth levels that they've achieved over the past decade, are going to resume leadership into bull market. So what is going to pick up the slack for or be the next leader? And when I start looking at sort of the spending, the demographics, the composition of the healthcare sector, the value, there's a lot of opportunities and a lot of tailwinds in the healthcare group for it to potentially be that sector leader over the next bull market. So we want to be able to put our own money in it, and we want to be excited about the exposure that we're having. On the competition side, the competition, it kind of goes both ways. So yes, it's competitive, but it's likely competitive because they've been able to attract a lot of assets. And so there's already a proof of concept there, if you will. So, really, we're not too scared of going into something that's really competitive if we're confident in our ability to provide a better sort of wrapper, a better performance over a longer term time horizon than what our competitors are doing, because it becomes a lot easier for us to sit down with advisors and investors and be able to talk about our product versus other products in the market and potentially see them switch out of something into ours. So it's very competitive, but that competition is also potentially the opportunity for us. In terms of building the product and what the exposure is, I'm gonna put up some slides here again, just briefly.
Sure.
When you can see that one.
Yeah, I could see it. Yeah.
So when when we sit down and build these, we want to have the same concept of CBNK. So we want to have this underlying passive exposure on that sort of $100 sleeve in the portfolio. So what is that $100 sleeve in this case? What you're looking at here are three very popular healthcare sector indices. So the bottom is the gray line is the MSCI World Healthcare Index. The blue line in the middle there is the S&P 500 Healthcare Index, which is market cap weighted. So the problem with that one for me is there's about 10 names that take up too much of the index. So if you look at the Johnson & Johnson's, United Health, Pfizer, Merck, there's about 10 stocks, and I think they make up about 60 or 70% of the underlying index. And then the top here is the equal weight healthcare index. And you can see the performance difference since inception back in 2006. So this is what we've decided on as our underlying exposure. So we want to go where that performance has shown that it's outperformed over time. But more so than that, we like the idea in an area that's fairly growth oriented and fairly innovative, to have more of a smaller cap representation by equally weighting out of the Johnson and Johnsons of the world and into something that's a little more innovative and, quite frankly, higher volatility. So, opposite of what we were talking about in the Canadian bank space, when you look at the healthcare sector, it's exactly what you want from an option standpoint, right? It's low dividend yields, which is, I think the dividend yield of the equal weight healthcare sector is about 1.1%, and high volatility when you start to dig under the surface. So at the sector level, it's fairly low volatility because Johnson and Johnson's low volatility, United Health is low volatility. But what you're looking at here is the 65 members of the S&P 500 healthcare sector, and then the 30-day implied volatility that you're getting. So we don't write options on Johnson and Johnson and United Health. We go to where we're getting 40, 50, 60, 70 vol in order to generate the option premium to fund the distribution. And it allows us to write less of the portfolio because we're generating the distribution in higher volatility stocks. Okay. So again, to your point, it allows us, it's that sort of balance between generating enough yield to fund the distribution, but also making sure that you're not selling away your upside. So we really want to focus on the exposure in the portfolio is doing, at least what the market is, if not better than the sector. Finally, in terms of the healthcare, this is a bit of a messy chart, but this is the S&P 500 healthcare sector relative to the S&P 500 index. So what you're looking at here is just you take the price of the healthcare sector divided by the price of the S&P 500 index. This goes back to 1990. So this is a very long chart. And as the line goes up, the healthcare sector is outperforming the market. As the line comes down, the market is outperforming the healthcare sector. So what you're seeing this year is the healthcare sector is drastically underperformed the market. So it's obviously been very growth and tech oriented, the S&P 500. So it's had a great year. The healthcare sector has actually not done much this year. And it's pushed us to this long-term sort of bottom channel of this upward sloping trend line that I'm finding very attractive. So I think there's a lot of opportunity in healthcare. If you focus on those bottom blue dots there, you can see that the last 5 times that we've hit this lower sort of channel in this healthcare sector, we've seen significant outperformance going forward relative to the market. So, and what I find very interesting is it's not just in up markets, but it's in down markets. So, even when the S&P 500 went down 45, 47%, the healthcare sector outperformed on the downside. When the S&P 500 sector when the index went up, the healthcare sector went up more. So it's a really interesting, I think, opportunity or time to be looking at the healthcare sector from a standpoint of outperforming the broader market. And we really wanted to create something that allowed people to play that with a higher yield, really because the yield is scarce within the healthcare sector if you're just getting it from dividend income. And then just finally on the healthcare sector, and sort of a reason that we're very excited about it, when I look at the market, I just have no idea where it's going right now. So it's a very, very confusing time, given what the Fed is doing, where interest rates are going, geopolitical. You got economic data declining, you got inflation potentially growing. It's a very, very confusing environment, and that could potentially create more volatility in the future. But what the healthcare sector has done very well over time has provided a counter-cyclical sort of earnings exposure to your portfolio. So what you're looking at on this slide, the last 6 times the S&P 500 earnings have declined in a calendar year, the S&P 500 healthcare sector earnings have actually increased in those years. So that's a real reason why it provides that relative outperformance in sort of volatile or potentially down markets. So we think it's a great sort of sector for all seasons at the moment, and that's really why we wanted to push to get this product out into the marketplace and start managing it. So we launched it back in February, and February? Yeah, I believe it was February. So.
It's very interesting stuff. I mean, I'm learning a lot. I had no idea that the equal weight completely is destroying in terms of performance the index-based one. But I'm not really surprised as well, right? And like you said, I think it's a good idea to have the equal weight. You're writing more the calls on the more volatile stocks. Yep. It's a defensive sector. I've always it's almost like a necessity. So it is very defensive in the bad times. And like you said, you're obviously bullish on, and you're optimistic about this sector, and your actively managed cover call strategy greatly reflects this, because you're not giving up any upside. You're still boosting your yield off a great defensive sector underrepresented in Canada. But you're very optimistic about it, and because of this unique cover call strategy, you get to capture all the upside and then some. So listen, John, very interesting stuff. I just want to thank you for sharing all this information. this wealth of knowledge. I think you're definitely on, you guys are on to something here. Very, very unique cover call strategy. You know, I talk to a lot of different investors. Some the priority is the yield, and some are more pessimistic than others. But I feel maybe these two, you know, really critical sector ETFs, cover call ETFs, are maybe designed more for people who are more optimistic, who don't want that cover call drag in performance, like we talked about, and capture fully the upside, but also want that yield. So I think it's very unique, and I appreciate your time and the slides and everything. Last question here for you.
Yeah.
I know you can't really answer, but I ask everyone. So, do you have any ideas of any upcoming similar? You got the Canadian banks one now. You have the healthcare one. Are you thinking of other similar cover call strategy ETFs in the future?
Yeah, yeah, absolutely. I mean, we're certainly in this space. We've been in it for 25 years, and you know, we've had a good start to the ETF business in a very challenging environment. I mean, we launched the Canadian Bank ETF in February of 2022, and the banks have what feels like have gone nothing but down over that period, and we've had one net redemption day over that entire 18-month span. So I think people are really they're appreciating what we're trying to accomplish with it from this exposure. You know, we look at every sector as a potential opportunity to employ this. It has to make sense. You know, so you know, we've had a lot of people ask us about, say, the utility sector, and doing sort of something around there. You know, I'm just, again, I don't want to put my own money into utilities right now for various reasons that we don't need to get into. But for that reason, we're not, you know, planning on doing something like that. But we constantly monitor this. I think there's a lot of interesting products coming around from our competitors as well, that we'll see how they do. And there's a lot of innovation in the Canadian ETF space, which is great.
Great.
So you know, we have lots of good ideas. We don't necessarily want to be a serial issuer. We want to really launch these and build them up and make sure they're doing what they're supposed to do, and then focus on the next one and build up our client base that way. So you know, lots of opportunities, and you'll definitely hear from us again. But we've actually launched 3 within the last 18 months, and we'll probably be on pace to do some more, hopefully, in the near future.
Looking forward to it. John, once again, thanks so much. Hopefully you come back on the channel when you have a new product, or we could talk about I'm very curious about the performance after 1, 2, 3 years when the banks rally or the healthcare sector rally, and see how these compare to other covered call ETFs. So it's going to be very interesting, very unique strategy. So John, thanks again for coming on, and we'll do this again soon.
Thank you. Thanks for having us. Thanks, Adriano.
Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades, and passive, I have half off for the elite membership if you're interested in the elite membership. And even if you want to start out with the free membership and upgrade to the elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the elite membership of passive is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.